What exactly is market psychology? Market psychology is the belief that a market's movements mirror, or are affected by, its players' emotional states. It is one of the central subjects of behavioral economics, an interdisciplinary study that studies the different variables that influence economic choices. Many people feel that emotions are the primary driving factor behind financial market fluctuations. The so-called psychological market cycles are caused by the general shifting investor sentiment. In a nutshell, market sentiment is the general sense that investors and traders have about an asset's price movement. A bullish trend exists when the market sentiment is optimistic and prices are consistently increasing, often referred to as a bull market. When prices continue to fall, this is referred to be a bear market. As a result, sentiment is comprised of the unique perspectives and sentiments of all traders and investors in a financial market. Another way to look at it is as an average of the market participants' overall feelings. However, like with any organization, no one viewpoint is totally dominant. According to market psychology theories, the price of an asset changes continually in reaction to the general market sentiment, which is likewise dynamic. Otherwise, making a successful deal would be far more difficult. In practice, when the market rises, it is most frequently due to an improvement in traders' attitudes and confidence. Positive market sentiment increases demand while decreasing supply. In turn, rising demand may result in an even more aggressive attitude. Similarly, a steep decline creates negative sentiment, which decreases demand while increasing available supply. What happens to emotions throughout market cycles? Uptrend. All markets go through growth and contraction cycles. When a market is expanding, a bull market, there is an atmosphere of optimism, confidence, and greed. Typically, these are the primary emotions that drive significant purchasing behavior. During market cycles, it is typical to notice a cyclical or retroactive influence. For example, when prices rise, sentiment improves, which drives sentiment to improve even more, propelling the market farther higher. A high feeling of greed and belief may sometimes overrun the market, causing a financial bubble to arise. In such a case, many investors become irrational, losing sight of the true worth of an asset and purchasing it just because they think the market will continue to increase. They get greedy and overexcited by market movement, expecting to profit. The local top is formed when the price becomes overextended to the upside. In general, this is considered the moment of greatest financial danger. In certain circumstances, the market may move sideways for a period of time while the assets are progressively sold. This is often referred to as the dissemination step. However, other cycles lack a distinct distribution stage, and the downtrend begins shortly after the peak is achieved. Downtrend. When the market begins to shift in the other direction, the exuberant attitude may soon convert to complacency, as many traders refuse to accept that the uptrend has ended. As prices continue to fall, market sentiment soon shifts to the negative. Anxiety, denial, and panic are common symptoms. In this context, we might define anxiety as the point at which investors begin to wonder why the price is falling, which quickly leads to the denial stage. Unacceptance characterizes the denial stage. Many investors continue to keep losing positions, either because it's too late to sell, or because they feel the market will recover shortly. However, when prices continue to fall, the selling frenzy intensifies. Fear and panic at this time often result in what is known as market capitulation, when holders give up and sell their assets close to the local bottom. The downturn eventually ends when volatility reduces and the market stabilizes. Typically, the market will endure sideways fluctuation before sentiments of hope and optimism return. This kind of sideways movement is also known as the accumulation stage. How can investors take advantage of market psychology? Assuming the notion of market psychology is correct, knowing it may assist a trader in entering and exiting positions at more advantageous moments. The market's overall attitude is counterproductive. The best financial opportunity, for a buyer, frequently occurs when most people are despairing and the market is extremely low. In contrast, the maximum point of financial danger often occurs when the bulk of market participants are ecstatic and overconfident. As a result, some traders and investors attempt to read a market's sentiment in order to identify the various phases of its psychological cycles. Ideally, they would utilize this data to purchase when there is panic, lower prices, and sell when there is greed, higher prices, higher prices. In reality, however, identifying these ideal spots is seldom simple. What seems to be the local bottom, support, may fail to hold, resulting in even deeper lows. Market psychology and technical analysis. Looking back on market cycles, it is simple to see how the broader psychology evolved. Analyzing prior data reveals which activities and choices would have resulted in the greatest profits. However, it is considerably more difficult to grasp how the market changes over time, and much more difficult to forecast what will happen next. Many investors use technical analysis, TA, to try to predict where the market will move. In some ways, TA indicators may be seen of as instruments for measuring the psychological condition of the market. For example, the Relative Strength Index, RSI, indicator may indicate when an asset has become overbought as a result of strong bullish market sentiment, e.g., excessive greed. Another indicator that may be used to identify the various psychological phases of a market cycle is the MACD. In summary, the relationship between its lines may signal when market momentum shifts, e.g., buying force is getting weaker. Market psychology and Bitcoin. The 2017 Bitcoin bull market exemplifies how market psychology influences prices and vice versa. Bitcoin soared from about $900 in January to an all-time high of $20,000. During the climb, market sentiment was more bullish. Thousands of new investors joined in on the enthusiasm of the bull market. FOMO, overconfidence, and greed soon drove up prices, until they didn't. In late 2017 and early 2018, the trend began to reverse. Many of the late-comers suffered big losses as a result of the subsequent correction. Even after the downturn was well established, many investors insisted on hodling due to misplaced confidence and complacency. A few months later, market sentiment shifted dramatically, with investor confidence reaching an all-time low. FUD and fear prompted many people who purchased at the peak to sell near the bottom, resulting in large losses. Despite the fact that the technology was roughly the same, some individuals were disillusioned with Bitcoin. In reality, it is always being enhanced. Biases in cognition. Cognitive biases are prevalent thinking tendencies that often lead to erroneous conclusions in people. Individual traders as well as the market as a whole might be affected by these trends. Here are a few examples. Confirmation bias. The propensity to overvalue information that supports our own opinions, while disregarding or discarding information that runs opposed to them. In a bull market, for example, investors may place a greater emphasis on good news while disregarding negative news or indicators that the market trend is going to reverse. Loss aversion is the universal human inclination to dread losses more than gains, even if the benefit is comparable or bigger. In other words, the agony of loss is generally worse than the ecstasy of gain. This may force traders to lose out on attractive chances or sell in a panic amid market collapse. Endowment effect. The propensity for individuals to overvalue possessions just because they own them. For example, an investor who has a bag of cryptocurrencies is more likely than a non-coiner to feel it has worth. Final thoughts. The majority of traders and investors believe that psychology influences market prices and cycles. Although psychological market cycles are widely understood, they are not always straightforward to manage. From the Dutch tulip mania of the 1600s to the dot-com boom of the 1990s, even the most seasoned traders have battled to separate their personal emotions from market sentiment. Investors must understand not just the market's psychology, but also their own psychology and how it influences their decision-making process. Thank you for watching.